Iman, I'm so disappointed in you.
Why is that?
So, you were supposed to get us some rational merchandise, clothing. Christmas is approaching and you've still got me wearing Uniqlo and Lululemon.
Unfortunately, there's nothing I can do about your style. Whatever I get you, you're still going to look ridiculous. As I say with Merry Christmas, everyone, by the way.
Yeah, ladies and gents, so thank you to everyone who has basically subscribed to the Rational letter. So if you go to rationalvc.com, aside from the podcasts, we also have original research, sort of very thorough, detailed founder guides, or just a view on the markets, anything about building or investing in tech. And we're now over 100 subscribers, so...
Woo, party. It's time to really bring the real stuff now in what we're writing about. So watch out for that.
So every month, over 100 seasoned founders and investment professionals at VC firms, family offices, endowments, etc. We now have these kind of people even subscribed. So they subscribe to hopefully better understand the tech industry. You don't have to commit. You can check out some articles we already have on the website and then make your mind up. But we do have, talking about merchandise, which Iman is going to sort out. No pressure. Apparently he has the plug. We are going to introduce a referral program soon. So stay tuned. If you subscribe, you'll find out details soon. But it's essentially going to be, if you do 4 referrals, you get it something like, it's not confirmed yet, but something along the lines of 4 referrals will get you a shout out on the pod with your Twitter @ or your company website. 25 referrals will get you a Rational Verified t-shirt, and 100 referrals will get you a Rational Verified hoodie and a 30-minute phone call with myself and Iman to discuss whatever you want. And we're going to have a leaderboard as well. So stay tuned. Seeing as it's Christmas and we've been planning this episode, we've been saying we're going to do it for a while. We're finally getting around to it now. Is for the past year, we're seeing so many SPACs everywhere. SPAC for you, SPAC for me, SPAC everywhere. And
SPAC for everyone. It's SPACSMAS, baby.
So we thought we'd do a SPACSMAS special. I suppose the first, I don't know how long it's going to go on, 20, 30 minutes. We're going to discuss SPACs, everything you need to know about them, what they are, the process, pros, cons. Go into a little bit more detail than what you may find, similar to our rolling funds episode where we had great feedback and we appreciate that, where we sort of went really deep, because online, if you go to articles or other videos or sources, it's sort of pretty concise. We do try and be to the point, but at the same time, we cover everything there is to know on the topic. After that, seeing as it's a Christmas special, and we're nearly 10 episodes in, we'll probably just talk about some other stuff that's currently going on in the markets. Yes, we have had some strong guests. We appreciate the feedback. We do have a lot more strong guests also in the pipeline that are scheduled to come on. But we can't throw them all at you all at once, guys. Come on, it's Christmas and you need to know about SPACs, because, as Bill Ackman says, you get 20% of the company tax-free until you sell the stock. That's why you have so many people doing it. Now, none of this, it may not make any sense. So let's dive into it, Iman. Enough faffing around. I'll dive in. I'll go in with a very quick 2-liner, and then I'll let you go into more detail and explain the process, and we can bounce ideas off and how this really works. I suppose both of us, the benefit and advantages here, you come from a finance background, you're still in finance. Of course, you're working with a lot of tech companies within finance. I'm ex-finance, ex-tech finance, that is, and now in tech. So we're both at the sort of intersection of being able to hopefully talk about SPACs and shed some light on what's going on. So many of you probably know, some of you may not know, a SPAC is a special purpose acquisition company. In a nutshell, it's a blank check company. So think of it as essentially a legal structure, which is, how do I say, an empty corporate shell, usually sponsored by a well-known investor that goes public by issuing shares and raising money from investors with a plan to buy a private company or companies to buy or merge with. So the merger, when it does happen, it takes the target company public without an IPO, without the company having to actually go through an IPO process the formal way. Now, the SPAC is as I said, it's a publicly listed shell entity with cash pre-merger, and post-merger, the shareholders hold shares in the merged or acquired company. We've touched on SPACs very lightly in previous episodes. When we did the rolling funds, we talked about the democratization that's currently going on in the space. There's a lot of good things about SPACs. So think of rolling funds as sort of the pre-seed seed stage of investing. SPACs is more sort of later stage when you're going public, and it's an alternative to, let's say, IPOs or direct listings. So yeah, Iman, let's dive in. However you want to kick this off. Maybe you want to explain the process. Whatever you want to do with this.
So, really good intro there. Basically, they're essentially just a nothing company. They have no operational business behind them, and essentially they go public really quickly because they have no operational business, right? So you're just you can essentially do a non-traditional IPO in the sense that because there's no backing business or backing criteria behind the business, it's easy to take it public. The process is really simple. And then another secondary point to what you were talking about is there's been a almost 2,000% increase in the number of SPACs that have happened since 2012, with more than doubling of the number happening between 2019 and 2020. Hence why we're talking about it. Hence why it's, I think, important for listeners and viewers to know about it. We've had, I think, more than 140 SPACs this year alone. So what is an IPO, and therefore what is a SPAC? So typically, historically, IPOs, as I'm sure a lot of listeners know, are just a way of taking a company public, and that could be for many, many reasons, but taking them public, putting them on a stock exchange, and doing that so that they can raise a lot of money, so the business can operationalize itself better by having cash to do the things it needs to do, whether that's grow new products, enter new markets, refine its products, sell to more customers, whatever they need that cash for. An IPO typically, historically, has been the way that they could do that. So what's different about a SPAC is the process is way faster. And so there's really 3 steps to a SPAC. The first step is you go public. And how do you go public? Well, you get a really famous person with clout in the industry. A really good example.
Chamath.
Yeah, well, exactly. An example is Chamath, that we can't go bloody episode without mentioning. So shout out Chamath. But you get other people like Bill Ackman, etc., who are also big names. If you Google or you YouTube Bill Ackman, there's a million things on him, and the media love him because he's such a good communicator and orator.
It's actually really interesting you mentioned there. So what I'm noticing is, and we'll go much deeper shortly, but it is really the sponsor and their ability to communicate and who they are as a person. So if you look at someone like Chamath, he left Facebook in 2011, I believe.
Yeah, 2011, 2012.
And he set up social capital around then. But ever since 2011, if you go on YouTube, where especially in the last couple of years, he's really blown up online, is he's one of the best speakers I've ever seen. He's very eloquent in how he speaks. Some would say he's brash. I just say it's a no-nonsense approach. I think it's amazing how he speaks. There's no BS, straight to the point. He has skin in the game. We'll go into some of his deals shortly, but it's really around, and we mentioned this on similar to rolling funds, you're really betting on, in a sense, the person and their ability. So the first step is, yes, you've got to be a good communicator, but the second step is you eventually got to build up a track record, i.e., Bill Ackman, Chamath now starting to build up the track record where people will bet on you based on not only essentially you could say it's social proof, really. That's the foundation of it. And then your deal proof really comes into it. But yeah, I'll let you carry on.
I think anyone can basically create a SPAC, really, as long as they've got clout in the industry. So watch how Kim Kardashian creates the next SPAC for B2C brands. But anyway, point is, you get a sponsor, someone with loads of clout, that goes and sets up a holding company, and then that holding company files to go public. And what that means is just that they float on a stock exchange, and because they have no background business to them, there's nothing that business does. It's just a holding company. It's a really swift process. You just file for IPO and go really quickly. You then go on a roadshow. A roadshow today is basically just loads of Zoom meetings, but you go on a roadshow and you find people that are interested in investing in this holding company, putting in cash into this holding company. But the difference is, when you do a traditional IPO roadshow, you're trying to sell a business or a product, right? So when Airbnb went to do its IPO roadshow, it's selling Airbnb's platform. It's saying, put money into the Airbnb platform. Whereas with this, it's more about, put money into me and my team as the sponsor, because further down the road, you give me cash, I'm going to go find a company that needs to go public, and they're going to be a really good company. And then when they do go public, you're going to get a crazy return on your money, because you float, and then the price of that stock goes up once it does float. Now that's what they're selling. So just to clarify, a sponsor isn't just one individual. It can be a team, but typically it's headed by one individual who's got loads of clout, and their team back them up with a whole bunch of experience that they have.
So with a traditional IPO, how it works is, as I'm sure most people would know, the deal is first announced and then negotiated. So if you look at, for example, WeWork, they filed to go public last year, and I've covered a lot on WeWork before on our website, on an article I've published. But they filed to go public last year, and they hoped to be valued at $96 billion.
Don't do this to me.
But investors backed away after seeing the prospectus, and so the WeWork IPO essentially failed at a time when, they badly needed cash in order to run the business. So the failure to raise capital caused the company crisis that left it on the brink of bankruptcy and caused Adam Neumann to resign, among other reasons. And in addition to, some other big unicorn IPOs where they've been a bit weak and achieved lower prices than they would have wanted, IPO suddenly seemed like an uncertain and risky process. Excuse me. So it's one that might end up raising money at a lower valuation that they wanted, or not raising money at all, in the case of some of these companies. So suddenly, SPAC mergers seemed appealing in Silicon Valley and in tech. And as such, a deal means the company will at least raise some money at a fixed price. So in terms of the comparison, I think that's pretty much...
Yeah. It's the reason why, and we'll get into this later on in the episode around the benefits of them, but it's a reason why they've blown up over the last year or so. The thing that happens once this sponsor gets cash from investors, or gets investors that are interested in putting money into this holding company, is that they issue shares, but they're not your typical shares that you'd get. They're actually two types of shares. One is you offer a share to the SPAC. So like essentially just a fragment of that business that sponsor is willing to give up. But secondly, you get a warrant. A warrant basically gives the buyer, the investor, an option to exercise a share purchase in the future at the current price. So essentially what you're getting is a 2-for-1 deal of getting a share in a business and an ability to buy the future value of that business at a discounted price if that share increases in price.
Yeah, and an example of this is Michael Klein of Churchill Capital. So this was 2018, I believe. They announced a $600 million SPAC. And what I've seen, Iman, is most of these SPACs, they essentially list for $10 a share. It just seems to be the thing. So Churchill Capital, Michael Klein, announced a $600 million SPAC 2 years ago. $10 would give you, as you've just said, this is an example of what you said, $10 will give you one Class A common stock and 1/2 of one warrant. So as you said, essentially a call option, which is you're buying the right to buy at a fixed price. And the fixed price in that case was $11.50. Of course, it's not like a forward contract or anything where you're contracted to purchase it. There's no obligation. It's just an option. And so of course, you'd only exercise this warrant if it was in the money at the time, i.e., so for those who don't know, the share price would be above 11.50. So you're getting it for cheaper at 11.50. So then the warrant can get very valuable if share price rockets in the next stage. Also, the next stage is they begin trading separately under different tickers. So the share will trade under one ticker, and then the warrant will trade under a different ticker, and you can trade them separately. And essentially, alongside this, of course, in the whole process, after the raise, they go and find the target company. Usually the way it works is they have 2 years, I believe, to find a target company. But it's never happened whereby they haven't found, the sponsor has not done a deal within the 2 years. It's very unusual to hit the time limit, as the creators of the SPAC earn a lot of money from doing the deal. And there's all sorts of complexities come from not doing the deal.
Yeah, that's right. I mean, the bigger point around that specific element is that these sponsors get what's called founder shares or promote shares, right? So a promote share is essentially just usually it's about 20%, but a big chunk of what the SPAC is worth will get paid up front for a really nominal fee by the sponsors. So in the case of Michael Klein, it was 25K they paid just to have 20% of shares before they went to find investors. And then that scales up once you invest in a company and that company does well. And that for them turned out to be something like $400 million. So 25K to $400 million is
insane.
It's a crazy incentive, right? But the point is, you kind of get to this point where investors are involved. The founders have their founder shares and they have skin in the game, really, realistically. And then you list the company, you list the SPAC. And once the SPAC is listed, it's now publicly traded. Anyone can buy the SPAC shares. So you'll see this with Chamath's IPO A, B, C. I don't know what number he's on now.
He's going to run out of the alphabet soon.
Yeah, he will. And then, I mean, yeah. But the bigger picture here is that, okay, now you've got all of these people involved. The second phase then becomes actually finding a company. And as you say, they've only got 2 years to find a company, and find that company, not just the sponsor and their team finding that company, but coming up with a reason to invest in that company. And then they need to go to all their investors and say, guys, we found this company. Here's the diligence we've done on it in a couple month period. And we think it's good to go and we should invest in this company. The investors then vote. And if there's a majority vote to take on that company, boom, SPAC done. They're going to take that company public by merging with the holding company. So the holding company eats the smaller company. And then because the holding company is already public, that smaller company becomes public. Their ticker symbol changes. Virgin Galactic's turn to space after that. I think it was IPO A happened. So you've immediately, in the space of in many cases 2 to 3 months, taken a company public and done it in such a rapid way that you bypass a lot of the regulatory hurdles you'd have in an IPO.
Do you want to talk about stage 3, and then I'll dive into we can start diving into pros, cons, and things like that?
Yeah, sure. So stage 3 is then you get to your de-SPAC, or your unwinding of the SPAC, right? So you agree your terms with the target. So this is where it's really interesting, is that when they find a company that they want to merge with, they do a whole bunch of negotiation around valuation and the purchase price that typically a company wouldn't be able to do in an IPO. And then once they agree and, propose everything to the shareholders and everything's agreed, the investors get a choice. They can redeem their shares that they originally paid, that $10 per share plus the warrant. They can redeem that net of any fees to take the original SPAC public. There's some very small fees involved in IPOing a SPAC. But anyway, net of those fees, you can get your money back and say, I don't want to invest in this company. I want my money back. I don't believe in what the sponsor's doing. At that point, then really interestingly, your SPAC can then basically go public, and sponsors can then say, okay, now we want to raise more money. We want to go to institutional investors using what's called a private investment in public equity transaction, or a PIPE transaction. This PIPE transaction is really interesting because typically when a SPAC goes public, they're not actually listing 100% of the value of that holding company. they're listing 25 to 35% typically. So then they go to institutional investors to back up all that money that they've got from investors originally and drive the investment even larger. And so once that happens, you've then got not only retail investors involved, you've not only got large scale investors involved in that original SPAC process, you've also got a whole bunch of institutional investors now involved, and realistically, you're legitimizing that SPAC process. And then fundamentally what then happens is there's a couple of regulatory hurdles at the end that the operational business that's merged with the SPAC needs to go through. So in the case of Virgin Galactic, they would have had to do some operational diligence and some legal work, etc., with the NASDAQ in order to get them listed. And then that process of the IPO is really fast. That happens really quickly. And then boom, the ticker symbol changes and you're good to go. That company is now listed.
Okay, so I don't mean to be a pessimist, but I want to dive into some of the downsides. So there was data compiled by the FT, and there's a graph of this. We're going to see if we can drop it in the show notes, actually. If you look at this graph, I think it's just over 50% of all SPACs from the last 5 years, just over 50% of these SPACs, they're trading below their initial price. So they're not always a success. And, another downside really is there's less scrutiny in the process. One of our favorite things, especially Iman coming from a strategy background and me banking, is the due diligence process. So there's less scrutiny in the process than there would be in a typical IPO for the same company if it were to go public directly. And so companies like Nikola, again, which I've published in the article I published alongside WeWork, who went public through a SPAC, they wouldn't have made it through the DD process required in a typical IPO. So investors who buy the SPAC in its IPO don't know what stock they're going to get. And so they're effectively buying a target company's IPO in advance without knowing what the target company is. However, these deals are structured such that if, let's say, investors don't like the target company, they can just back out of the deal by getting their money back before the merger closes. If you are a company, now this is more sort of downside from the management team's perspective, I guess if you're a garbage company in some cases, it's your only way out. We will get to the pros. If you're a great company, it can also make sense for you. It just depends on the current situation of your company. But if you're looking to go public through the SPAC approach, one of the disadvantages are the fees. It will work out to be much higher than a regular IPO.
You could look at it from two ways, right? Which one's the lesser of two evils? Because either you're going to pay that 5% or 6% to an investment bank, and everyone hates investment banks, and then or you give up more equity. And what I mean by that is when sponsors, how sponsors had that 20% of the lump of that business, they give 20% of the holding company, but they don't have 20% of the business. It gets diluted and it gets translated to about 1 to 5% of the operational business. So what they're still giving up a shit ton of equity, right? But it's comparable in value to what you'd pay an investment bank. However, what you're doing is you're going into bed long term with the sponsors. With an IPO, you won't with the bankers. The bankers just take their money and go.
Exactly. And also SPAC fees, they come to around a quarter of the money raised, if I'm not mistaken, which is let's say 3 to 4x as much as an investor would normally pay in terms of fees to participate in a regular IPO. And a lot of these fees are actually, okay, we've talked about the downside to the company, but a lot of these fees are then passed on to the actual investor. So the poor investor who in a lot of cases, again, with a democratization, you're seeing anyone and everyone and their auntie getting onto these apps and buying into these things. Look, in my view, we've both got our own views, but in a nutshell, I think the fees in a SPAC are just sort of better concealed than they are in an IPO. And as you said, besides the money in the SPAC, there's obviously a thing called a PIPE, which is a private investment in public equity. And so PIPEs are another type of investment vehicle typically held by the SPAC sponsor's management team or other investors associated with the deal. I just think it's a bit of a sneaky way with the whole the way they structure the deal and they pass on the fees?
You can't actually back out of the merger, and you can't get more warrants if you do like the merger as well. In most cases, that doesn't happen. So actually, even though you've got the option to pull out early on when the deal's announced, you typically won't, right? It's $10 a share, and typically, like, it's the best way to put it in layman's terms is it's high risk and low reward for retail investors in particular. Now, for institutional investors and, following the PIPE action, I mean, look, fundamentally, they might make a good deal out of it, but you've just quoted it. I mean, most SPACs failed. 58% of SPACs failed between 2003 and 2013. Now, there's a whole bunch of weird stuff that happened in that period where everyone hates SPACs, and there was a really bad name to SPACs in the market then, and you've got some good names, some big names coming in and actually offering even better terms to operational businesses to merge with SPACs, like Bill Ackman's doing currently with his $4 billion SPAC. So there are options and ways that have enabled SPACs to become better investments in recent years. But mate, 60% of SPACs failing, and Nikola being one of them, is enough for me to just say something dodgy has happened in the past and is continuing to do so, particularly given it's a new vehicle for investment in the markets.
Agreed. I think the concealment of fees, the poor due diligence, examples such as Nikola, the high rates, as you said, 58% of them failing or not doing very well. Yeah, I mean,
there's one other thing though. There is one other thing, which is what happens with everything in the investment markets is your supply of companies that you could target as a SPAC will fall down really quickly if you get any more bad SPACs happening. So essentially what you're going to have is way too many SPACs and not enough targets. And so you'll get a SPAC crash. So all of the SPACs that wanted to invest in potential targets will crash and everyone will have to take their money out. And that's not good for the SPAC market. It's not good for Bill Ackman. It's not good for Chamath, etc. And it's just going to make the whole thing a lot messier and not nice.
Okay. Any more downsides before we go into the pros?
One thing I've read, and I'm not sure I agree with, is that because you've got this 2-year time horizon, that sponsors will rush at the end of the 2-year mark to find a company to invest in. And then that's when you get the shit companies like Nikola getting invested in, because they're running out of time. They don't want to lose all this capital they've had, and the sponsors don't want to come across as a failure. So those two things compounding sometimes mean that they make kind of shitty choices. But to be fair, in recent SPACs, that hasn't happened. And we'll get into Chamath and stuff, but you're getting better opportunities emerging in the space.
Advantage, or you could say cost saving, is that there is no IPO pop. So think of the SPAC as more like an acquisition and not an actual IPO. So as we saw in the recent Airbnb case where there was a pop with the IPO. So the IPO price, which is actually the source of capital for Airbnb, it was only $68 a share. So I think with the shares outstanding, that was about $3.4 billion of capital. But on the first day of trading, it then shot up to $145, which is great for investors, who are into the shares, but made no difference to Airbnb as all of their capital was raised at the $68 price. So if they had raised capital with a SPAC, they'd have just got the money at a fixed price. And, Airbnb wasn't an exception. You often see that pop in the share price. We also saw it in the case of DoorDash, where the IPO was, I believe, $102, and then it shot up to $187 on the first day of trading.
Yeah, I mean, actually, an interesting side note on Airbnb. So Airbnb was apparently approached by Bill Ackman's SPAC to do a SPAC with that $4 billion that they had in investment, and they refused. They refused, I think, for a number of reasons, but the main one would have been that they'd already started. They were already happy to move down the IPO route. They had strong partners in Goldman Sachs, Morgan Stanley, and Allen and Company, who were their legal team. And so they were happy. They had assessed the options and highlighted that the risk would be higher in a SPAC, and so they weren't happy to do it. So it just shows you that you can actually choose between the two. And in the case of Airbnb, they chose not to do it. So fair play to them.
Correct. Okay. Any advantages from your side?
Well, my next memo is going to be on the democratization of investing in the space. So watch out for that. And SPACs plays a big role in that because typically IPOs are closed things. You couldn't have invested in Airbnb when it IPO'd. You could only invest post price increase. So you would have been paying the premium as a retail investor. With a SPAC, you can actually get in on those deals far earlier, and so you get a share of that pie, pretty substantial pie in a lot of cases. You also get the kind of cop-out option, I call it, or the redemption option, which is phenomenal as a retail investor because it essentially says if I'm not happy with this investment, I'm going to pull out. And then if you do like the investment, you get the option to double down at a cheap price. So you get that warrant option, which all of three of those things make it a really good deal for people that either don't really know what they're doing with their money or that they want to bet on someone who knows what they're doing with their money but isn't 100% certain. So I think for retail investors, it's a beautiful opportunity.
Also, what I do like about another thing I like about SPACs is so the SPAC creator, they invest some of their own capital. So in the case of Chamath, and so he has skin in the game. And there is an alignment of incentives, which again, I've outlined in my article going into deeper detail, but I believe one of the fundamental underlying issues with what we're seeing in the tech markets, or the irrationality, which some would argue some overvaluation and BS companies like WeWork and Nikola and things sliding and just everything that's going on. I think one of the core underlying sort of factors that plays a big part of that is investors having no skin in the game. So people are going to say shots fired, but in the case of SoftBank and WeWork, SoftBank with a load of sovereign wealth funds that they've raised, and so they don't really have skin in the game. It's excess capital they're just throwing and burning. Whereas someone like Chamath, and as he calls it, Silicon Valley's kind of turned into a Ponzi scheme, but as he's got skin in the game. He puts his money where his mouth is, and so it's great. And I think Ackman is great, and I quoted him at the start of the episode, but what he's trying to do. So I want to go back to something you mentioned earlier, actually, which is you discussed the net promotes and just sort of the percentages and the structure. And so I've got this graph, and it's from a Harvard Law School paper that recently came out. It's called A Sober Look at SPACs. And they have this graph, which is for each share that was worth $10, there is $6.67 in cash, $3.33 in dilution overhanging the merger. And so we have here SPAC costs as a percentage of cash delivered in mergers, including pipes. The median, we're not going to look at the 25th or 75th percentile, we're going to look at the median. The net promote is 31.3%. The underwriting fee is 7.2%. Warrant and right cost is 16.6%. And so the total cost of the SPAC is 50.4%. So, these are Bill Ackman, and what I quoted him earlier is he said you get 20% of the company tax-free until you sell the stock. And that's why you have so many people doing it. And so those are the promote shares that we outlined. And so that's why everyone's doing it. The founders and sponsors get a great deal, but not so much the investors. But the reason I said I like what Bill Ackman is doing, he's removed some of the benefit to sponsors. So it's better for investors. And people like Bill Ackman and Chamath, I think there's a reason they're doing well. There's a great alignment of incentives, and it's not very one way, if you know what I mean. So
the point around their incentives is really important, because the incentives that they have for investors, the incentives that they present for investors are great, and they provide financial stimulus for those investors to feel more confident. But on the flip side, they also get another benefit, which is, as a sponsor, you're typically a really well-established person in the market, and so you have an idea of what strategy should look like post IPO. And these people, these sponsors, because they merge with these private companies to take them public, they actually become part of their advisory boards. And so they have very strong post-deal strategy implementation ability that they otherwise wouldn't have if they were an investment bank taking them public. So what you get is a double whammy of people like Bill Ackman giving you financial incentive to invest in these things, but also people like Bill Ackman who know what they're talking about, helping from the sidelines run the business so that it performs better in the longer term, so that your value of your shares look better. Does that make sense?
Yes, clear enough, I think, for everyone to hopefully understand. Anything else? I think we've covered most of the pros. I'm trying to think.
I mean, we've talked about pros for investors and pros for your sponsors. There are pros for companies that we've also touched on. The speed you can do it in 3 to 4 months versus the traditional IPO of being 6 to 36 months.
In some cases, even 8 weeks, you can do it if your sponsor's on point and you have all the docs that you need and your accounts are crystal clear.
Yeah, ready to go, really. And in fact, you can do a SPAC in 8 weeks. And then if you've already identified the company you want to take on, you can even supercharge that negotiation process that follows and don't use the 2-year process, 2-year deal timeline, for the process. And then you can just go public really quickly. So within 8 weeks, you can have a company basically listed. And then for the company, you've also got 2 other benefits. You get certainty in cost. So you're certain of the cost that you're going to be giving up. You're not going to be paying those legal fees and those investment banking fees we spoke about. And as a business, unlike an IPO, you can actually negotiate your terms with the SPAC sponsor. You can say, I value my company at this, and the sponsor says, I value it at half of that, and you can come to an agreement that's 3/4 of the way there. Whereas with a traditional IPO, you can't do that. The investment banks do the DD on your business and then come up with a valuation. And then thirdly, it builds on the point that I made earlier, which is you get strategic partners. So the people that help grow your business post IPO are people that are invested in your business and sit on your board and really want to help you grow. And they have really, really, really strong experience, both the SPAC sponsor, but also the experienced team that sits behind the sponsor.
Is it a case of how VCs operate, which is, all the memes of, hey, how can I add value? But really similar to how a VC is, let's say, has their finger in several pies. In some cases, the investor may even have their own company, have their own fund on the side, have a ton of angel investment, be on the board of companies, advise a bunch of companies. Then they have to keep up with the PR and stuff. So it's very similar in that sense. I think people like Bill Ackman and Chamath are extremely busy. And so I'm not discrediting those guys, but I'm saying just generally any sponsor, especially those who are not as, in my view, who may not be as good as, let's say, Chamath or Bill Ackman or have as much experience, those with a lot less experience who are just running around extremely busy, can they really add so much value? I mean, if you're a company who's not been able to go public via an IPO for whatever reason, and it could be for a good reason that you're deciding to go through a SPAC, but I don't think there's that much value that they can add, to be honest.
If they can't add value, what they can definitely do is gas you up on Twitter and then also put you in touch with, they can link you in with people. So if you're the CEO of a company that's merged with, let's say, Chamath's SPAC, what can you do? Chamath can put you in touch with basically anyone. If you need help from Amazon to help grow something and pitch to Amazon, he can most probably put you in touch with Bezos, right?
Yeah, but while the sponsor can gas your company up, at the same time they can also artificially pump your share price as well.
They definitely can.
And so, it could be a case of pump and dump in some cases with less reputable sponsors who may not have as much experience, which is probably that 58% that Iman referred to, which sits below the initial $10 price that haven't had much success.
We've spoken about Chamath in such a positive light, same with Bill Ackman, but I couldn't be rational with my rational head. By the way, I did a 16 personalities test recently, and I am an architect. Only 1 to 2% of the population are architects, and we are fiercely rational individuals. So I would be remiss if I didn't bloody say something rational here, which is Clover Health is one of the SPACs that Chamath did. Clover Health was not trading very well recently. As soon as they announced the deal, I think there was a ridiculous drop. I'll put a link in the show notes, but there was a ridiculous drop in the value of the IPO. in the value of the company even. So even with a great name and potential great support, your company can kind of go to shit. And on the side, recently, I think it was a couple of days ago, that Chamath said he's pulling out some of his shares in Virgin Galactic. So, it's not all rosy and dandy in SPAC land.
I think it was a small amount. It was, I think he had 34.
Yeah.
I think he had, I don't know the exact figure. I think it was sub 10% of his shares. I'm not sure. Also, just off the back of that, this is the fee that the sponsor gets is kind of like the carry that VCs receive. In the case of, who was it? I think is it Kevin Hart's?
Kevin Hart?
Not Kevin Hart, Kevin Hart's. So he did a SPAC, and on a $200 million SPAC, he said there's a 50 million promo that's earned. We've already covered this, but if the company doesn't perform and drops in, let's say drops in half over 1 year, 1.5 year period, then the shares are still worth 25 million. So we're talking about all of this skin in the game and incentives, fine, but there may be a reason you have skin in the game if you're still getting paid so well by the end of it.
We need to start a SPAC, man.
Ladies and gents, Rational VC SPAC A incoming. More details.
Rational SPAC incoming.
Okay, I think we've... Anything else on SPACs?
No, but you've clarified to me what the future of our investing world looks like, and I'm ready to go.
I had a nice quote to end the SPAC thing with before we go on to sort of some other light topics. Where's this quote? It really ends with, if you are a company that wants to go public and you're looking for a calmer, more rationally priced alternative to the IPO process, a direct listing might be a better idea than a SPAC merger, or you can set your sight to an IPO. Yes, we've discussed downsides of an IPO. Yes, it takes longer. Yes, there's more due diligence required. Yes, it may even cost a bit more in some cases, but as the saying goes, anything worth having or achieving takes work, and face the discomfort. Success leaves clues. Do it the proper way. There's more longevity. And, I think that's the most rational way we could end SPACs. I'm not ruling it out, of course. There may be a requirement for you. If you're an investor, again, as we have all our disclaimers, this is no investment advice, but I would personally stay away unless you really know what you're doing, or unless you're a full-time investor, stay away from SPACs, or unless you're just willing to speculate and throw a bit of money that you're not necessarily willing to lose, but if you lose it, you're fine with losing it, similar to, let's say, crypto, and you just really like the idea of supporting a particular sponsor because they really inspire you. So be careful, know what you're doing, be clued up. If you're a full-time investor, even then, probably do another episode. We're doing an episode soon on the book by Morgan Housel, The Psychology of Money. And in that, we'll probably break down step by step the best way for the everyday person to invest. Even if you do work in tech or finance, I think everyone should probably read that book, but we'll provide our commentary on the highlights of that book and the advice and what we took away from it. But my view for investors, stay away unless you're full-time and you're really clued up. If you're a company, again, stay away and try and do an IPO or direct listing unless the advantages of a SPAC outweigh it for you. And if you're a sponsor, there are no downsides. Go and do as many SPACs as you can. So I guess, as we can see, the incentives are not aligned here. Hopefully, as I discover and Iman discovers more information over time, we may, and obviously more regulation is introduced, we may start to favor SPACs more. Currently, I wouldn't completely rule them out, but I'm leaning more towards, let's say, a direct listing or IPO for investors and for companies. Except for SPAC sponsors, they're the only ones that seem to keep eating out of this process.
Well said.
Great. Very, very rational, coherent ending. So now that that's out of the way, we can just riff on a couple of other topics, seeing as it's a Christmas special episode. Do you have so if you're a new listener, the way it works is if me and Iman do an episode together where there's no guest, we ask each other, do you have a tweet of the week? Just any tweet that you came across on Twitter in the last few days. And so, Iman, walk us through your tweet of the week if you have one.
Yeah, I've got a good one, and I think you'll like this because I know your thoughts about tech outside of Silicon Valley or tech outside of California, but there is a tweet by Kundil Capital at Kundil Capital. And it's basically screenshots of an email exchange between Dan Loeb, who's a prolific investor, and someone who is a prospective employee. And the tweet says, "The market doesn't care who you are or where you came from. You have to be ruthlessly competitive to succeed at this game. And if Dan Loeb asks you for your 3 best ideas, they better be good." What he's referring to is the screenshots of the email conversation where Dan Loeb is emailing, and I won't mention his name, but someone from another capital, from another investment firm. And the guy emails him and says, "Thanks for the call earlier today. Enclosed is my CV for your review. I'll look forward to following up with you when you have more time." So a very normal email. And Loeb just responds with, and this one, managing member of Third Point Capital. He responds, "Nothing, just what are your 3 best current European ideas?" And then the guy gets obviously a bit offended, and it says, he says, "I'm sorry, but it does not interest me to move forward in this way. If you wish to have a proper discussion about what you are looking to accomplish in Europe and see how I might fit in, fine. Lesson 1 of dealing in Europe, business is not conducted in the same informal manner as the US." And then this email exchange just keeps going on. And Loeb is just like, "Okay, fine. 1 idea would suffice. We're an aggressive performance-oriented fund." And he goes into, to explain why he doesn't think Brits would align well to the US culture by saying, "We find most Brits are a bit set in their ways and prefer to knock back a pint at the pub and go shooting on weekends rather than work hard. Lifestyle choices are important, and knowing one's limitations with respect to dealing in a competitive environment is too. That is lesson 1 at my shop." And then he just keeps going. They say that the prospective employee says, "I guess your reputation is proven correct. I've not been in traditional fund management for more than 11 years. I did not achieve the success I have by knocking back a pint," etc. So he's backpedaling. And then Loeb just comes back with, "You'll have plenty of time to discuss your place in society with other fellows at your club. I love the idea of a French-English unemployed guy whose fund just blew up telling me that I'm going to fail." And they just keep going back and forth. I'll link the tweet in the show notes. It's quite a long read, but I highly suggest reading it if you want to see some funny exchanges between a US and a Britman.
I love this. I pulled up the tweet. I'm looking at it, and Dan Loeb in the last email, he says, "At Third Point, like the financial markets in general, one's place in society, quote unquote, does not matter at all. We are a bunch of scrappy guys from diverse backgrounds, Jewish, Muslim, Hindu, etc., who enjoy outwitting pompous asses like yourself in financial markets globally." And he goes on and on. Anyway, I think this is amazing. As Iman said, again, I always say controversial things, but I really think the future of tech is China and US. Silicon Valley will continue, despite people saying everyone's fleeing SF and going to Miami, and yes, but generally SF and generally just the US in general is always going to be at the forefront of innovation, whether that's biomedicine, just software, anything and everything tech. Like, I just think Europe, and us being in London, and look, I'm in the process of looking at making a move in the next couple of years, hopefully to the US. Previously I worked in an American company, and a lot of Americans used to move over from the US to come and work in the UK office. And they're always surprised at the number of holidays that the Brits had and how much time people would take off. Whereas in the US offices, it was just typically 10 days per year you take off, and that's it. I love everything that Download said in this, and Download did come back with a tweet because the emails got leaked, and he came back with, if I could advise my younger self, I would say to avoid such confrontational interactions and to treat everyone with kindness and respect. Lewis was clearly not a cultural fit for me or my firm, on and on. But I think I'm ignoring that. I like what he said in the email, basically. My tweet of the week is by Chris Back at Chris J Back, Bakke. And he said, in 1972, Warren Buffett bought See's Candy for $25 million. Since 1972, See's Candy has produced $2 billion in income for Berkshire Hathaway. Pretty good, but he's 90 and still working in Omaha. Had he invested in Bitcoin in 1972, he'd have like $400 billion and would have been able to retire in a world-class city like Miami.
This is coming off the back of Bitcoin breaking 20K this week. So there is a lot of mania, I would say, on Twitter around Bitcoin. I think it broke 24K yesterday as well. But the Bitcoin mafia have come out strong.
And of course, everyone on every tech bro or everyone on VC Twitter has been moving to Miami and leaving SF. Look, I'd gladly, if you're, the mayor of sort of SF or whatever, if you're anyone somewhere high up, if you're hearing me out, I'd be glad to pay double taxes just to live in your amazing city. And people are leaving, I'd be happy to do the opposite and go there. So, but Mayor Francis Suarez has been all over the place. The mayor of Miami, he's been all over social media, online, and really with a lot of the power plays from Silicon Valley who are moving to Miami, taking them in. Really, I think he's doing a fantastic. I've never seen anyone from sort of political standpoint take such an active approach to welcoming people, and sort of, he's young, he's bright, he's driven, and he knows what's up. He knows that this could change the game for Miami long term. We may try and get him on the pod. Let's see.
That's an open invitation for Francis Suarez to come on the show, snippet this and put this at the front of the show.
Anything else you want to discuss, Iman?
No, just Merry Christmas and a Happy New Year. We've gone into Tier 4 in London, which basically means lockdown again. So hopefully everyone is happy, healthy and safe.
Cool. Guys, everyone, Merry Christmas. As I said, we've got lots coming in the new year. We really appreciate anyone and everyone who's joined us this year, who subscribed to the articles, who listens to the podcast. We've barely even started. So much coming for you in 2021. This is just the start. We appreciate anyone who's tuned in. Got a referral program coming soon. Sign up on rationalvc.com to the Rational letter, and you'll get details about the referral program, where, I genuinely really appreciate all the feedback we've had recently. We've had great stuff coming in. We also do love constructive criticism as well, on how we can improve, whether it's what you'd like to see more or less of in the articles, similarly in the podcasts. But yeah, lots coming. Merry Christmas, everyone, or Merry SPACSMAS, and see you next week.
Peace.